From the NXT studio in Southern California, this is the Power and Market Report. I'm Albert Liu. I'm joined today in studio by Don Luskin, the economist and author who is the Chief Investment Officer of TrendMacrolytics LLC. His articles have appeared in numerous publications, including the Wall Street Journal, Washington Post, Harvard Business Journal, and the National Review, among others. He's been the economic advisor to 2 presidential candidates, and he's a regular guest on the Fox Business Channel. Don, thank you for joining me here at Studio B.
Thank you.
It's great to see you. We got a lot to talk about, but I wanted to talk a little bit about your background because we never ever got into your background in the 2 other times that I talked to you. Are you aware of what Wikipedia has been saying about you?
Oh, I certainly am. I used to try to bother to fix it, and there are people with more sophisticated technology to undo whatever I do nanoseconds later.
Right.
I suspect bots are involved.
Let's start with the basic. You attended Yale.
I did.
This is true. On your blog, did you state that you attended Yale and dropped out to rejoin the real world as soon as possible?
That is true. I only completed my freshman year.
Okay. What was the thinking behind this? Because you were quitting Ivy League schools long before it was fashionable to do so.
I feel I established a trend.
I think you did, actually.
But the ones who really went on to big things, though, they dropped out of Harvard. Okay, so I just started wrong.
No, don't diss Yale. It's funny because there is obviously you have Gates, you have Zuckerberg, you have numerous others, and then you have, as always, when you have these gurus or trendsetters, role models, you have people who try to emulate that.
Yes.
But they forget that to drop out of an Ivy League school, you first have to be admitted to one and do the work and everything it takes to get in there. How do you feel about that decision now? Was it what prompted you to rejoin the real world, as you put it?
I very much wanted to get out and work and produce. And I felt that being in school was the equivalent of having been drafted. I felt I was in the military. I didn't want to follow orders. I wanted to pursue my own dream, win my own war. And this was at a time when the Vietnam War was still raging. So I was obviously a very coddled person who thought that Yale was like being in the military, considering that the military is really what it's like to be in the military.
That's right. That's funny. So your career, looking at sort of things you did early in your career, I mean, really like innovative stuff in the area of passive investing, index investing. I didn't realize how early you were in the whole target date mutual fund.
I'm the named inventor on the patent for target date funds.
Incredible.
And I had the good luck to end up working for 11 years at what was then called Wells Fargo Investment Advisors. And it's gone through a series of acquisitions. It's now part of BlackRock.
Yeah.
But that's the place where every fundamental advance in modern portfolio management was first put into actual real-world practice. And it was just an amazing hatchery of people and ideas and careers. So we had people like Myron Scholes, William Sharp, Fisher Black.
Really?
These were, the very first index fund was invented at Wells Fargo by Fisher Black 2 years before Vanguard.
I was going to say, Vanguard gets a lot of credit. They deserve some credit, obviously.
They deserve credit for bringing it to a retail audience.
Yeah.
And that's great.
Yeah.
But they certainly didn't invent the idea or do the first one.
Now, when you were doing this, so you were experimenting, I guess, with index mutual funds and that sort of thing, like more passive forms of investing. Did anyone tell you that this will never catch on ever? Like, active is the way to go.
We knew from the very beginning that this was going to end up destroying the world. And it's taken 30 or 40 years, but it, I think, actually has ended up destroying the investment management business. It's certainly transformed it. When I joined it in the late 70s, it was just a gentleman's club. It was a monopoly of gurus who just had these ineffable mystic visions about which stocks to buy.
Right.
And they appeared on Wall Street Week and published newsletters and charged ridiculous fees that are multiples of what the most richly compensated investment manager makes today.
Yeah.
And our insight was that those fees alone give you an advantage to just buy the market.
Right.
And never mind the fact that these gurus generally become gurus by having performed well for 4 or 5 years, and by the time you hear of them, they're just about to enter their down cycle in relative performance. So by indexing, you save the fees, you avoid the performance cycles, and it's taken decades to catch on. But it's just the default way to do it now.
Yeah, so the product that you incubated that became iShares
Right.
basically is ubiquitous
Yes,
now.
that's right.
Has it gone too far now? Has indexing gone too far now that it's entrenched in the retail domain?
Back in the day, the question people always used to ask us is, what would happen if everyone did this? And I always used to say things like, well, I don't know, what would happen if everybody in New York City flushed their toilet at exactly the same time? I guess maybe that wouldn't work either, but it never happens. This, though, is about to happen. We are perhaps about to have 100% passive market share. And when that happens, there are going to be no economic incentives whatsoever for anybody to do any kind of research into individual securities. And when that happens, then the opportunities in such research will just be absolutely enormous. And those opportunities, if not the fees, will draw people back in.
Right. Pendulum will swing back.
It has to.
The other way.
Yeah.
Do you think people at Charles Schwab and TD not too long ago were saying 0 fees? Are you kidding me? That'll never happen. These Silicon Valley guys are crazy. We'll never see a world with 0 fees. You think that ever happened?
Well, I remember in the 90s when the Netscape browser was software, very valuable software, very innovative, world-changing software that was given away free. And people just couldn't figure out what their business model was. And now that's completely transformed the world. And again, it's just amazing that it took a quarter century. But now investment management is being operated on the same principle. Yeah,
it's funny you mentioned free. So I received this book from you this year. But what you just said reminds me of the book that you sent over last year.
Yes.
So which is
Life After Google by George Gilder.
Right. Amazing thinker that gentleman is, and just sort of the shift to the free model, and now you see that is like basically coming into finance.
Right.
It's inevitable.
Yep.
He argues that it's a bad thing in tech. Do you think it's a bad thing in our world?
I think as long as people understand what they're getting into, it's neither good nor bad. What would be bad would be going into it with your eyes closed. The reality is there's no such thing as a free search engine. There's no such thing as a free securities transaction or a free index fund or anything else.
Yeah.
Somehow these people are making money.
Right.
Make no mistake about it.
Right.
Supposedly free Google is making a great deal of money for its shareholders and its executives.
Right.
Question is, how are they making it?
Yes.
So you're getting all those free Google products. What are you actually paying other than money? Well, you know what the answer is.
Mm-hmm.
You're giving away your privacy.
Yes.
And they'll tell you, oh, well, didn't you click I agree when they pushed their new privacy policy? Oh, sure, yes, you did click it. Did you read it? Oh, you're the one out of 1 billion who read it.
Yeah, no one reads. No one reads those things.
And the amazing thing is the people who read it, they still click.
Mm-hmm. So in the world of tech, then was it Tim Cook said that look, if you're not paying, you're not the customer. Basically, I think it was him who said that, right?
Yeah, well, and he went further to say, and if you're not the customer, you're the product.
Right. So map that to the zero commission brokerage model.
Right.
What are you?
Well, the way the dirty little secret there is that these companies make their money by getting paid for order flow. So this isn't like the old world where your order goes to the New York Stock Exchange and there's some dignified specialist on the floor of the exchange who matches your orders with everybody else. It goes into some dark pool or some high-speed trading network that competes with other high-speed trading networks and will pay Schwab to send that network Schwab's business. And so what are they doing? They're picking you off. Mm-hmm. That's why else would they pay Schwab for your business? Right.
So another example of selling privacy or selling your information.
That's right.
To be used.
That's right.
By someone else.
That's right. In this case, it's selling the information about your own order flow.
Right. So the book that I received this year which I'm really looking forward to because he's one of my favorites. I'm a former engineer. The funny thing about engineers is we all love this guy. Even the guy with the curly tie loves this guy.
Yes.
No one knows it's the joke's on them, but this arrived, and what I really enjoy is the little insert that you're clever enough to insert or thoughtful enough to insert for my compliance team. And it says, compliance notice, this book is not a gift. It is a non-gift. It's being provided as substantive adjunct to Trend Macro's investment research reports. When the Google book came, that was plausible. Now I'm thinking, is he trolling my my legal colleagues?
Well, you're the one with the compliance burdens, okay? So you're only undercutting yourself by asking me these questions.
But we complied. I mean, this came through official channels with this nice note and went through all that, and they gave it to me. But I want to give you
I'm quite sincere about it. This book, Lose or Think by Scott Adams, is a book that every investor should read because investors are all about processing all the information, all the news, all the rumors, all the real news, all the facts, all the fakes that come to them. And this is a book about how to train your brain, train your sensorium to detect real from fake. And what more important thing could an investor do?
In this day and age,
Well, ever.
Yeah, but especially now. But I wanted to get you a non-gift, so I thought, what can I get Don? That's symbolic of Southern California, San Diego.
Something
what are we known for? Yeah, we're known for great weather, beaches, homelessness, homeless problem. You can't package that. So I needed something that was also keto friendly, and so this is coffee from a local place called Bird Rock.
Oh, nice.
It is certifiably Californian, meaning it's free trade, gluten free, all of that good stuff, sustainable, and actually this is also an adjunct to a discussion we're going to have because it's an illustration of sort of the insatiable desire of Americans for their coffee.
Mine is insatiable. Hand it over. Thank you.
Yeah.
Thank you very much. Appreciate it.
Hope you enjoy it.
Fantastic.
So let's get on to, I guess, some of the more substantive stuff here. Let's talk about, I guess, the state of the economy right now. We just had Black Friday, which was somewhat successful. It was down. The numbers were down, but the online numbers, obviously, smashed. And here we are today, Cyber Monday. So all seems good in terms of, I guess, the consumer, right? I mean, the fact that it's shifting from brick and mortar to online is, inevitable and not a bad thing.
The patterns of retail trade have changed on a regular basis for millennia.
Yeah. So do you believe the consumer is strong? This is indicative of a strong consumer, and will that last? How long will that last?
Well, it'll last until it doesn't. I mean, everything it takes to have a strong consumer is in place. We've got unemployment rates that we haven't seen in half a century. We've got new highs in inflation-adjusted household income, which that really took some doing, too. It took 10 years to get back to the pre-Great Recession highs, and we did that a little earlier this year, and we're just now on a spike to new highs. Every month the numbers come out. It's just amazing. So, this is all it takes to support the consumer, just jobs and money.
What was surprising to me is the amount that in the private debt, how much consumer debt has fallen. Again, a good sign.
Well,
consumer
great
balance
sign.
sheets.
I think the best way to think about consumer debt is to look at it in a ratio to income. Right, the dollar amount of debt doesn't matter because what matters is can you service the debt, and debt service ratios are more broadly financial obligation ratios, which include things that are not debt but nevertheless are an obligation upon you, like say having to pay insurance premiums. Those are all at all-time lows in the history of the data. So if you go back just a little bit more than a decade, during the housing bubble before the global financial crisis and the Great Recession, those were all at the highest in the history of the data. Right. So we've had a decade of consumer retrenchment, which now, 10 plus years after the end of the Great Recession, is showing as a flourishing, growing consumer who got there without levering up. That means that if the consumer ever wants to lever up, he's got room to.
Yeah.
Because that's the problem with too much debt. You can't add more.
Right. Right. So, and I agree, consumer looks good. The banking sector seems sound, according to the Fed anyway.
I don't know if it's the most exciting business to be in, but it's sound.
Well, yeah.
See, that's the problem with banking. If it's sound, it's probably not profitable.
and it's getting harder, obviously.
Yeah.
But in terms of what the Fed is worried about, I guess they're not worried about profitability per se. They're more worried about heading off the next crisis. So things look, by their measures anyway, the collateral is sound, leverage is in check, right?
I guess so, as our Fed chairman is fond of saying.
Yeah.
The economy is in a good place.
Right.
Oh my God, we've got Mr. Rogers running the Fed.
Oh yeah, we're going to talk about him.
Okay.
But what is the catch, or is there a catch?
I don't think there's a catch. It's just that as you move forward through time, eventually, something bad's going to happen.
Yeah.
You never know what it's going to be. It could be the same kinds of things that have caused good business cycles to end in the past. No, I don't forecast this. In fact, I forecast the opposite. But you could conceivably have an oil shock. You could have something that stops global oil supplies, and oil, goes to $300 a barrel, and there are lines at gas stations again. Well, that would cause a recession.
Yeah.
You could have the thing that's caused most recessions, more than any other, is the Fed tightens interest rates too much. And I'd say a year ago, last December, they were raising rates too high. They were too tight. And now they've unwound that. 3 rate cuts this year. So that's looking good, but the possibility of error is always there. I think the biggest threat facing the global economy is a secondary consequence of the trade dispute that we're in with China. It's not that the tariffs are causing any particular problems. We can talk about that separately, I assume. The problem is that in order to get China to negotiate with us at all and change its trading practices, which it likes just fine, thank you very much, we're having to subject their economy to a lot of stresses through the tariffs, through the depreciation of their currency that the tariffs have caused. And China has never had a recession. Modern China, 40, 45 years old, never had a recession. Recessions are very hard to have. So when you have your first one, you're probably going to really blow it. When China finally has one, it'll be very disorderly, and that could be a global event. Now, I'm not forecasting that's going to happen, but it will happen eventually if we don't resolve this trade war.
Okay. These are big shocks, obviously, that you're pointing out, and that could derail almost any economy.
Right, but absent those shocks, economies don't just derail themselves.
What about the fact that, so Powell says this was a mid-cycle adjustment. Before he did that, it was looking like it was more end of cycle. I mean, this time last year when you and I met, it's volatility, horrible December. It looked like we were end of cycle. We talked about the trade war last year. That obviously hasn't been resolved. And there's two things that seem to be affecting the economy more than anything else is the Fed and China. China's not resolved. So it looks like the Fed single-handedly turned this around with the cuts. Would you, or just the pivot signaled by the cuts? Is that what you see?
Well, that's not wrong, but it's not really right, because the Fed didn't intervene to save the world. The Fed undid its own mistake. So Jerome Powell's narrative is, well, we here at the greatest central bank in history, we never make any mistakes. We were right in December when we'd had a terribly turbulent quarter, and we raised interest rates on December 19th, and while I was speaking at the post-FOMC press conference, the S&P fell 100 handles. Oh, we were right to do that. We were right to say the balance sheet is on autopilot weeks before we completely changed our balance sheet policy. We never make mistakes. This is all Trump's fault somehow. We're not sure exactly, or maybe it's Brexit. Yeah, it's definitely not us.
Yeah.
Wrong. It was
Seems like it was them.
Yeah, it was the Fed's fault. They were at least contributors. Their fingerprints are certainly on it.
Yeah.
Failure has many fathers. The Fed is certainly one of them. Now, the good news is that the yield curve inverted in May this year. That sent the Fed a loud and clear smoke alarm message.
Right.
House isn't burning down, man, but you got a fire in the kitchen. So put it out. And they did.
Yeah.
So, yeah, they made a mistake last December. They unmade it. Did they save the world? Yeah, they saved the world from themselves.
Yeah, that's often what these institutions do, right? Government and other
and
institutions.
They expect you to thank them.
Yeah. What about what's going on with earnings. What is going on with earnings? You see, we had tax cuts and sort of debt-fueled buybacks boosting earnings per share. But what is the real earnings story?
You can look at earnings just as an absolute dollar amount without even taking into account the number of shares outstanding. I think that's one of the right ways to do it.
Mm-hmm.
That shows you the total dollar earnings power of the S&P 500. That went to all-time highs a year ago, October 25th, and then was stagnant for about 11 months. And it's now gone on to new highs, and actually, as we speak, looks like it's kind of stagnating again. So, it's fine, but in an average world, corporate earnings tend to grow, say, 6% a year. Really good year is 10%.
Yeah.
Lousy year is 2%. There are good reasons for it. More than all of the dip in S&P earnings over the last year can be explained by just one sector, energy. Oil prices have been in a secular bear market, and they've had a very, very difficult year and a half. And that has wiped out earnings in the energy sector. And I think of the, seven or 8 billion in annual earnings right now that S&P 500 earnings are off all-time highs, 5 times that is explained just by that one sector, energy.
Okay.
That's not meant to be an excuse, it's just an explanation.
Right. So sort of nominal earnings or dollar number earnings is a way to look at the business, but investors look at earnings per share.
Well,
obviously.
as you should, because it matters how many other people you have to share those dollars
It does
with,
matter.
right? Yeah, so it's a question of, if you're a macroeconomist and you're just saying what's the earnings power of corporate America, then you look at the dollars.
Okay.
If you're trying to do a valuation exercise, then you need to look at per share.
Right. So in sort of, I guess,
that looks much better, of course,
catering
because
to
the buybacks have.
So the consequences
kicked
of
in.
that is you've sort of changed your finance structure and also flooded the debt market with I think it's record high corporate issuance, right? A lot of it triple B. Are you concerned about that?
No.
You're not.
No.
And why is that?
Well, we have a record high dollar value of earnings. We have a record high stock market in terms of market cap. So record high debt is just another thing that's record high. I mean, these things are all just in perfectly reasonable scale with each other.
What about the argument that the next recession, when it eventually comes, sooner or later it will, right, is going to cause a lot of that debt to be reclassified and then sort of cause a run on the newly classified junk debt?
Well, every time there's a recession, a lot of debt gets extinguished. Mama said there'd be days like this.
Yeah.
And, we free market capitalists, we dread having to live through it.
Mm-hmm.
But, these are the kinds of experiences you have to have.
Yeah.
It's just like reading the privacy statement from Google. When you're going to buy one of these bonds, read the damn prospectus, all right? Is it guaranteed anywhere you're going to get your money back?
Yeah. Yeah, no.
You can't expect there to be zero defaults.
Right. I'm going to throw something up here for you. This is your own report. You just take a look to your left, Don. You'll see it coming up.
All right.
There was one chart. Let's talk about valuations here.
All right.
Okay, so explain what I'm seeing here. This is equity
right.
risk premium represented by forward earnings minus 30-year treasury.
Right. So the equity risk premium is an idea that was evolved in the 70s at Wells Fargo by William F. Sharpe, who went on to win the Nobel Prize for the capital asset pricing model. It's a very simple concept. It is that investors are paid differentially over time. Sometimes you're paid a little, sometimes you're paid a lot, to take the extra risk of holding equities as opposed to holding bonds.
Yeah.
So both bonds and stocks are each risky in their own way, but certainly stocks are more risky. So you should get a little extra expected return.
Mm-hmm.
And so you can tell how much risk premium you're getting by some proxy of what the expected return for stocks is, minus some proxy for what the expected return of bonds is. And as you said correctly, what we're looking at here is the forward earnings yield of the S&P 500. So think of the forward earnings yield as the forward PE upside down. It's imagine that you bought
Mm-hmm.
100% of the stock of the shares outstanding in the S&P 500. So you're not only entitled to the dividends, you now have a claim on 100% of the earnings. So you can think of the earnings as a yield to you. So no matter what happens to the price, you do get those earnings. So the price you pay produces that earnings yield. Now you could buy a 30-year treasury, and you know what the return on that is going to be. It's going to be the yield to maturity. So you look at the difference between those two yields, and the difference is the extra juice you get for taking the risk of holding equities. Now, there are times when you get a huge extra premium for bearing risk. And of course, that is at times like during the global financial crisis where there's a lot of risk to bear.
Yeah.
And nobody wants to take any risk. Everybody
Right.
wants to own bonds, nobody wants to own stocks.
Yeah.
Then there are other times when you not only get no risk premium, but weirdly enough, the risk premium actually inverts, like sometimes the yield curve does. So in times like late 1999 or early 2000, or late 1987, just before the crash of 1987, the equity risk premium actually turned negative. So you were not only not getting paid to take equity risk, you were actually paying to take equity risk. That didn't work out so well.
Okay.
So this is not necessarily a market timing tool, although if you've followed it for 35 years as I have, you kind of learn to use it that way. It's not even an equity valuation tool. It's
Okay.
a relative valuation tool between the two primal investment opportunities that you have, stocks and bonds. And if you look at it over the broad sweep of history, and we've calculated this back all the way to 1900, right now, the relationship of stocks and bonds, weirdly enough, is almost exactly at its average for the last 119 years.
Okay.
Now, that average includes 2 world wars, depressions,
Yep.
just some amazing stuff.
Yep.
So it's kind of odd that as we speak, we're just poised at that average. Obviously, we move around that average a lot. Over 10 or 20 year periods, we call them regimes, you will have a persistently high equity risk premium, as we've had for the last 10 or 15 years. Sometimes you have a persistently low equity risk premium, like you had in the 80s and the 90s. Seems to me that if you, a relevant way to look at this would be within the framework of the local regime, and that's what we're doing in that chart. So that green line is the average equity risk premium that pertained during the global financial crisis from 2007 through 2013.
Okay.
There was a huge amount of risk in the world. You didn't know if the ATMs were going to turn on or not. So if you are earning anything like that risk premium, and we're not in that crisis, you're probably getting a pretty good premium. So think of it as you're in the business of writing insurance policies on cars. And a little old lady from Pasadena who hardly ever drives her car is willing to pay you the same insurance premium as a 15-year-old boy who's just learning to drive and is probably stoned. So, yeah, you're going to take that money. And right now, stocks look pretty good on that basis.
And the reasoning behind using a 30-year time horizon was what, as opposed to...
You get about the same result if you use the 10-year, but the reason you want to use 30-year is that's the longest duration government bond that there's a lot of data for. And stocks, because they don't mature like bonds do, they have infinite duration. So you want to look at long duration bonds versus long duration stocks.
Okay. So one of my favorite economic pundits, James Grant, referred to low interest rates as the equivalent of beer goggles for the investor. If we're looking through beer goggles, can we believe the yields we're seeing for the 10-year and the 30-year?
Well, look.
Or use them the way that you did historically.
Right. Well, Grant is a very funny, eloquent, charming writer, but part of what gives him the sense of authority with which he writes is he is very much grounded in history, which, when it comes to financial indicators like interest rates, really just is nothing but indulging in nostalgia. Why is it useful in today's world to know what interest rates were in 1735? I guarantee you that Jim Grant knows exactly what interest rates were in 1735, and he'll tell a hell of a story about them. But we live in the world we live in now. We live in a world of massive wealth, of global graying, aging demographics, where for the first time in history, we have an infinite amount of money versus a finite number of new human beings being born every year in whom we have to invest. So why should interest rates be the same as when we were struggling to build the first canals in the United States and women were having 10 children?
Yeah, it doesn't
world.
necessarily need to
So
be.
it's not
but I don't think he's saying that.
It's not beer goggles. No, that is what he's saying. Because he's saying that low interest rates are something that you can determine just by looking at digits. He's saying, 2%, that's a small number. That's single digit. It must be low because it used to be higher.
Is he saying
no, that
that?
doesn't mean it's low. You're just not looking at the context.
I think in his defense, we don't know if it's low, and that's one of the criticisms. Is what is a neutral rate of interest? Like, what should it be? If the Fed was going to posture sort of with neutrality, we don't even know what that would be. Isn't that sort of an imaginary figure? So to your point,
it's not imaginary; it's unobservable.
Yeah. Right. It certainly exists, but we don't know. And I think you would agree with that. I mean, we don't know whether or not 2 is high or low.
Well, we don't know whether it's high or low relative to what interest rates would be if there were no central banks manipulating them.
Yes.
And that was another point I wanted to make about the beer goggles, that the real question is not whether they're high or low, it's whether they're real or fake.
Uh-huh.
Because if they're low and real, then don't object. But if they're low and fake, that's crystal meth.
Right.
And he acts as though if they're low, they're fake. Now, here is a way. So he's a student of history, so I would ask him to go back 120 years to the work of the Swedish economist Knut Wicksell, who is sort of the founder of monetary economics. And he was the one who came up with this idea of the neutral rate of interest. He called it the natural rate of interest. The interest rate that would obtain not only if there were no central banks, but even if there were no money.
Right.
Even if there were no banks, right?
Right.
And his argument was, you can't observe it, but there is a kind of mirror you can look through to kind of detect if it's there. Or, to put it in sort of modern terms, you remember that great classic Universal monster movie, The Invisible Man, where you couldn't see the Invisible Man, but you could detect him by seeing his footprints in the snow, and that's how they ended up getting him, right?
Yeah.
So the way you see the footprints in the snow for the natural rate of interest is you say, is there inflation or is there not? Now, if there's inflation, then probably your rate is below the natural rate, and probably some stupid central bank put it there. Now, if you've got deflation, on the other hand, probably the rates that you can see are too high, because some central bank put them there and they were wrong in that direction. So right now, do we have a large amount of inflation that should make people think a priori that interest rates are artificially low? No. In fact, for the last 10 years, there's not a major central bank in the world that's been able to hit their measly 2% inflation target despite trillions of dollars of QE and zero interest rates and negative interest rates.
Yeah.
So I don't think this is fake.
Yeah.
Now, can I just say one more thing?
Of course.
You can certainly get into very elaborate arguments about the imperfections of the way inflation is measured. Fair enough.
Yeah.
But we've been using the same imperfect methods for a long time, so at least they're roughly comparable period to period.
They've been tweaking them, though, right? They tweak them from time to time.
They
right?
tweak. I think in their own way, they're sincerely trying to make them better. And there are lots of arguments about how to do it.
Yeah.
There are questions about what do you do when the price of the Encyclopedia Britannica goes to zero thanks to Wikipedia.
Right.
And I can tell you personally that the value of Wikipedia is in fact zero. But just saying, let's just assume that the inflation numbers are approximately right.
Yeah.
If that's true, then the interest rates you can observe are not fake low, or you'd have an inflation problem.
So let's say the bond market, or the signals that the bond market is telling us they have integrity, we can still trust them. What's the 10-year at, I think, 1.8 today, telling us, with inflation somewhere between 1.5 and 2?
Right.
Is it pricing in a recession? What are bond investors telling us?
Well, far be it from me to say a kind word about Jerome Powell, but I do want to give him some credit. He made a very profound observation. He's made it a couple times in speeches and congressional testimony. To him, the 10-year is Mr. Market's estimate of the neutral rate of interest. And I think that's actually a very clever, very deep observation. Because it's true that central banks are mucking around in that market to some extent, but not all that much compared to the scope of that market. So it's probably a reasonably legitimate number. You asked, is it discounting recession? Is it discounting deflation?
Look at where GDP estimates are. Look at what the 10-year is with inflation,
right.
and you
there's another component that you want to look at, which is that long-term bond yields, even Treasury yields, impound a so-called term premium, which is not just the anticipated level of inflation, but it's an option premium that's built in to the extent that you believe that your forecast of inflation is likely or unlikely to be wrong.
Okay.
Right? So one of the things that the 10-year is telling us is that investors, apparently low estimates of inflation over the next 10 years, it's not only low, they're really confident about it because they're not building any risk premium into that. They're not building any extra yield in case they're wrong.
Right.
So what the 10-year is telling you is some combination of inflation's going to be low, nominal growth is going to be low, and the variability in inflation over 10 years is going to be very low, and we're really sure of that.
I think what Bill Dudley wrote recently was that the market is more concerned about a recession than it is about inflation. Is that?
Well, so let's bring up our copy of Loserthink and read the chapter on mind reading.
Yeah.
Where he says quite correctly that so much of what pundits say, even when they just say it about other people,
right,
people just have this amazing hubris about imagining they know what plans and intentions and emotions are going in other
so we don't know
minds. But oh my God, Bill Dudley takes it to a whole new level where he's not just imagining what Donald Trump thinks. He seems to know what the whole market thinks. Come on.
Okay. Let's talk about China. Let's go to China. We were talking about a resolution to this thing, maybe Q1 or Q2 last year. That didn't happen.
That did not happen.
It seems like, and correct me if I'm wrong, but Trump is a little bit vulnerable now. And it was obvious that he was going to be vulnerable in this way in the sense that he has to worry about getting elected, right?
Sure.
So he sort of needs something. And it seems like he's or they've, I think quite cleverly, manufactured a way to succeed with this phase 1 versus phase 2 versus further phases. Do you agree with that assessment?
Yeah, I do, and I'll kind of double down and triple down on it. I think the way you framed it is that he wants to get some kind of victory that he can claim.
Right.
But the thing I want to add on to that is, let's say he had a choice between doing a phase 1 deal and doing a comprehensive deal that would impound all desired future phases, and you just get that done. I would argue that he seems to have, and maybe there's some mind reading here, that he's made the decision that it's actually better to do a small deal and demonstrate victory and then go into the election still as America's trade warrior. And the reason for that is he has so successfully, in less than 2 years of conducting this trade war, totally changed the narrative about the way Americans and American politicians who represent them perceive China. Gone are the days when we believe as a nation that China is gradually, in its own way, joining the community of nations, and it'll all be fine. We have to just engage them, and we shouldn't be hostile toward them. And if we could just open one more McDonald's franchise, then democracy will break out all over. So, some of the dead-enders on that, like Michael Bloomberg, for example, they still say things like that. No one else does. That there's not a single Democratic candidate other than Michael Bloomberg who is not on record saying that, well, I hate Trump's trade war just because it's Trump's, and it's just terrible how disruptive it is, and I hate the way he tweets and seems to make up things as he goes along. He doesn't, engage our allies, and so all these style points. Mm-hmm. But wait, okay, so you hate it. Would you withdraw his tariffs, Miss Elizabeth Warren? Oh, no, not at all, because I'm tough on China. And in fact,
that is a change.
I would add other forms of pressure, because the problem with China isn't just trade. It's that China is the tool of the evil multinational corporations that I am sworn to bring down. China is the world's largest coal consumer, the largest carbon footprint in the world. China doesn't permit labor unions. Oh my God, China is way worse than Donald Trump thinks. So Now you're China, and you're watching that spectacle, where even Pete Buttigieg won't go on record saying he'll repeal the tariffs. Now you're saying, well, look, let's say it's 50-50 that Trump gets reelected. If we, China, don't play along with him and give him his little victory, which he appears to want now, then if he wins anyway, he's really going to be pissed. And he's hard enough to deal with now. But wait, what if he loses?
Yeah, you get someone worse.
Look at Elizabeth Warren.
Yeah.
You know, at least Trump is a deal guy. At least we're used to him. So, you know, I think that's what's going on here. I think China has made a decision that it is in China's interest to support the re-election of Donald Trump. And the art of that deal has been that Trump wants a phase one deal so he can go into the election being as tough on China as any Democrat. And China can give him his phase one deal, which will have as its critical moving part the end of the ag products boycott. So in all those swing states where our loyal patriotic farmers are supposedly angry at Trump, you know, whether they are or not, really, don't know. The media narrative is that they are.
Yeah, but you could see why they might be.
Actually not.
No?
I can see why the media says they might be, because the media says whatever it has to say to oppose Trump. Did you know that under the same statute that allows the president to unilaterally create these tariffs, the president also gets to administer so-called trade adjustment relief, and that more has been paid out to farmers over the last year than the total dollar value of their exports to China in the prior 12 months?
Okay.
So if you're a soybean farmer, what would you rather do? Sell $1 billion worth of soybeans to China, or get a check from Donald Trump for $1 billion and not even have to plant? You would so do that. So are the farmers really pissed off? I don't know, but it's a media narrative that Trump's going to shut off, that's for sure.
Okay. What do you think is taking so long with it? I mean, the phase one was designed, I assume, to be easier. Maybe take out some of the sticky intellectual property stuff or other things that might not get agreement, and focus on ag, as you say, because that needs to get done. What do you think is taking so long? Or is this just orchestrated drama here? What?
Oh, I think it's orchestrated drama on both sides. You know, we're talking about very, very competent negotiators on both the U.S. and the Chinese side. And even if you've agreed to a scaled-down deal that only deals with certain subject domains, you're always going to take it down to the 59th second of the 23rd hour. That's just the way big negotiations are. And the thing that's driving it to conclusion is the December 15th onset of the next set of tariffs. So it's pretty much got to get done before December 15th. Now, in the news today, did you see that Trump is reimposing steel and aluminum tariffs on Argentina and Brazil on the grounds that they're horrible, terrible currency manipulators? Without offering my opinion about whether that's true or not, let me just say that one of the items that's supposedly getting folded into the phase one deal with China is to get them to articulate some kind of rules by which they will manage their currency. And so this is probably a shot across the bow to them.
What about the idea that we can avoid escalating on December 15th without a phase one deal? You can separate the two.
Certainly possible. There was an increase in the tariff rate from 25% to 30% on the 2018 tariffs that was supposed to take place on October 15th, and that was waived or deferred with no phase one deal.
Right.
So, you know, that's the thing about these enabling statutes the president is using. He can just do anything he wants.
Okay, let's talk a little bit about the election. You had another chart here. First term presidential approval ratings. Trump, according to this, is not doing that well, but maybe well enough to get.
He's doing terrible. He's got the same approval rating as Obama,
but not as bad as Carter.
Right.
So there's hope for
but not
him.
as good as the first George Bush, who didn't get reelected.
That's true. Okay.
So what this is telling you is that if you're horribly unpopular like Carter, or if you're way popular like the first George Bush, you don't stand a chance. You want to be in the middle. You want to be perfectly mediocre. America loves mediocre presidents.
Why is that? That's strange.
Yeah, I don't know. Maybe it's they don't want abject losers like Carter, but on the other hand, they like their gods to have feet of clay. You know, we're basically a populist nation.
Carter, would you say he was a loser per se, or was his economy a losing economy? I mean, that seems to be sort of the critical thing there.
I'm going to say I'm older than you are, so I remember this in real time. I remember the smoking ruins of helicopters in the desert and our failed attempt to rescue the hostages in the Iranian embassy. And I remember we think the media is rough on Trump. Well, I mean, it used to be that, the nightly news would come on. This is when there were still only 3 networks. So it was ABC, NBC, and CBS. And they all had their, it's day 307 of the Iranian hostage crisis. And the implication being, what are you doing about this, Mr. President?
Right.
Meanwhile, he's giving speeches from the Oval Office wearing his little sweater because he's turned the thermostat down to 60 because there's an energy crisis going on and lines around the block at gas stations.
Yeah, that's a striking image for sure.
Well, by the time 1980 election time rolled around, we were slipping into a recession, which by most metrics was every bit as bad as the Great Recession, 2008 and 2009.
Okay, so given this and other things you're watching, you think the president gets reelected?
We have an election prediction model that's based on 6 economic variables, most of which are going in Trump's favor, a few are not. Also based on the fact that first-term incumbents just always get reelected. And there are certain rules that explain the ones who don't, but mostly they do. So that gives Trump 80 electoral college votes just going in. Then all the other economic variables come together to give him approximately another 150 electoral college vote margin. So this model is saying that he's going to win by, I think, 270 or something electoral college votes.
Yep.
That would be in the general neighborhood of Obama's 2 wins. So it's not that that's undoable in the modern age. It seems undoable for a Republican, given the red-blue state divisions, but that's what the model says. The model was correct in 2012. It predicted Obama, got it within 4 electoral college votes. The model was right in 2016, predicted Trump when every other model was predicting Hillary. By the way, this model does not include approval ratings or polling data at all. We've got the data, we put it in the model, and it makes it worse.
How does the model account, or do you account for this impeachment, for example, the damage it may have done, reputational damage, whether it's successful or not, right?
The model doesn't look at that explicitly. The model, I guess, makes the implicit assumption that if there's anything so terrible about the impeachment, you would see it in economic data.
Okay.
And you certainly did when Richard Nixon was having his crisis.
What about your opinion on the role that social media is going to play this time around? You see many of the social media channels sort of trying to bow out of this, Facebook kind of hanging in there. What do you think their role is or should be, and what effect?
Well, let's go back to the beginning of our conversation. These are the people who buy and sell you as their product while telling you that their product to you is free. So the similarly deceptive narrative they're giving you now is that they're going to ban political ads because that might influence the election. All they're saying is that they want to be able to influence the election all by themselves, thank you.
It's worth more to them than the money, than the money they would get from it.
And it's just so easy to do, and there's pretty good documentation that's being done.
Wow.
All Google has to do is slightly bias its search results. And there's lots of evidence they did that in 2016. Now, the funny thing about elections is that they're determined by a surprisingly small number of voters across the whole country. So you don't have to influence that many Google users.
This is fascinating because it's, I guess, a fundamental difference between the old and the new media channels. Because then the old media channels, they love that revenue, don't they?
Right, absolutely.
I mean, papers, TVs, radio, they live off of that.
The new media love it too. It's just that it's subjecting them to the risk of political regulation. And so they're trying to drape themselves, with some kind of insulation against Washington coming down on them for all the other sins that we've been talking about. So they're just trying to look virtuous.
But Facebook doesn't care about the appearance of virtue, or?
Have they ever?
They haven't, actually. Okay, I'm going to ask for your prediction for 2020. But before I do that, I want to play your prediction for 2019. I don't know if you remember what you said, but you're going to enjoy this. No, you're going to enjoy this, I think. Okay. Let's play this.
What happens with all these market gyrations? We settle down? So we settle down.
Hey, from these levels, you definitely settle down. Because this is a low bar on that.
No, it could get worse. It could get worse.
We'll see.
Yeah.
We'll see. Not for long, but it's certainly possible.
I mean, we're going to have a negative year.
Yep, first in a long time.
Yeah, so 2019, do you see the resolution of the trade war enough?
I think you're going to be very glad you were in risk assets in 2019.
All right.
That's an understatement.
Hey, that was pretty good.
20%, 25%, 30%.
And it ain't over yet. The day is young.
You think? We got 1 month to go. We had a rough...
I'll tell you this. As I go around talking to our 80 institutional clients, one thing I hear over and over, and it scares me, is can we just end the year now?
Right, absolutely.
Right?
Which, I mean, so that could be trouble.
I agree with that. It tells you there's a kind of a fragility in expectations out there.
If you got 25, 30% and you're getting paid
just go to cash. Money? Just go to cash.
Right?
You're done. Good
now, people aren't doing that.
Yeah.
Maybe a little bit today.
Right.
You're not following, but...
you want to hear a hilarious thing about that negative return year that we indeed had? You know, by the time December 31st rolled around, I can't remember exactly what day we did that interview. I think it was sometime in Christmas week. Mm-hmm. But it ended up being 4.5% negative return for the S&P 500.
Yeah.
If you just look at the days when Jerome Powell did something, when he gave a speech or did an FOMC meeting, those days ended up being about a negative 10.5% return. So if you just take out the Powell factor, we would have had an up 6% year last year.
But that's sort of what's happened this year. So because he's flipped.
Yeah,
right?
It's become net positive this year.
Yeah.
Yeah, he's gotten back to zero from the beginning.
So it was more not Powell per se, but Powell what his bias was in 2018 versus 2019. By the way, who would you have rather have seen? Were you someone who was happy to see Powell at first and then incredibly disappointed?
That was another great prediction on our part. We had him tagged from before the beginning. he is simply a political hack. At best, he speaks economics as a second language. And even if his policy ideas were right, which is impossible since he actually has no policy ideas, he's truly an empty vessel. He's a lawyer, a swamp creature, born and raised in Washington, went to the same prep school as Brett Kavanaugh.
Isn't he doing what Bernanke and Yellen said eventually had to be done? Like, didn't he try to do last year what his predecessors said would be necessary? I mean, weren't they saying that, these are extraordinary measures, so we're taking interest rates down, we're engaging in QE, these are extraordinary measures. The process forward, and it's easy to say when you're not around to have to do it, but the process will be to unwind the balance sheet.
Will it?
Well, apparently not now, but I thought that's what was the whole agreement we had with them when they launched on QE, was that this is extraordinary, it'll be unwound, and then we'll normalize interest rates. They're not doing that.
This gets to be a degree of technicalness that your audience may or may not be interested in, but I'll try to keep it brief. They do call the reduction in the balance sheet normalization, that's for sure. But they've always been very silent about what its terminal value will be.
Okay.
And
really?
People read into it.
Did they let us believe that it would?
Yeah. So if you're Jim Grant, that means it's going to go back to $1 trillion because that's what it was before the global financial crisis.
Right.
I can give you some really basic reasons why that was never going to happen, but there are some tolerable reasons why it should be smaller than the $3.5 trillion where it is now. But at any rate, the thing that wasn't given sufficient credit by the audience for these statements and probably wasn't articulated well enough, certainly not articulated well enough on December 19th of last year when Powell said it was on autopilot, is the idea that until 2008, when the financial crisis hit, the Fed had gone 95 years without paying interest on reserves. Then the Fed started paying interest on reserves. And as soon as you start paying interest on reserves, now you get this big balance sheet, because all of a sudden people are willing to leave
Right.
money with the Fed. Why not?
Right.
You'll earn interest on it. And you never would if you won't earn interest on it.
Right.
All those years of supposedly zero interest rates, the Fed was giving you 25 basis points for leaving money on its balance sheet. That's how it funded all those bond purchases. Now, a consequence of doing that is that banks now have incredibly plentiful reserves, whereas in the prior regime, banks wanted to have the smallest possible legal amount of reserves, because
Right.
anytime you left reserves on the Fed's balance sheet, you were losing the opportunity cost of interest.
Right.
So if you ever needed extra reserves, you'd go to the Fed funds market. As soon as they started paying interest on reserves, they killed the Fed funds market. It basically doesn't exist anymore. The way they administer rates now, even though when the FOMC meets, they still pretend they're adjusting the Fed funds rate, they're adjusting a rate in a market that basically doesn't trade. When the FOMC is done meeting, the 7 political appointees in Washington, the actual governors, not the whole FOMC that includes a rotating cast of the regional presidents, everyone leaves the room except for the 7 governors. Those 7 governors say what the interest rate on reserves is going to be. And that's the real policy rate. So it's like at Thanksgiving, where the kids and the adults all get to eat at the same table, then there becomes an adult table.
And within that table, does the chair have sort of
Just 1 vote out of 7.
But does the chair influence
Well,
those?
one of Powell's sins, although you say it's just a preference, is that his revealed behavior is that he is not an autocratic CEO who has strong opinions about policy and tries to force them on his board. He's not an economist. Why would he have strong opinions? At least he has enough self-knowledge to know he doesn't deserve them. That's great. So the consequence of that is it's actually a vote.
Really?
Every 7 weeks.
Okay.
And it's been 50 years since that was true.
I was going to say
Yeah,
that's
so we had, Volcker, Greenspan, Bernanke, Yellen, these really strong, opinionated, domineering people. And when they spoke to the market, you knew what policy was because it was coming from them. They were the CEO.
right.
Powell is not that. He's a bureaucrat. He's a vote counter. So every FOMC meeting, you don't know what's going to happen. It's not him. But the bottom line here is that the interest rate that really matters is the interest rate on reserves. That's something we've only been doing since 2008. So we're experimenting to find out how big the Fed's balance sheet has to be. Because let's say the Fed's balance sheet was reduced to $1 trillion from the $3.5 it is right now. You're going to figure out what the interest rate on $1 trillion is? Well, that's not enough money. That's not enough of people's money so that they care what the interest rate on it is. So you got to get $3.5 trillion, $4 trillion. We're still figuring out what that level is so that when you change that interest rate, you change interest rates across the whole economy. That's a learning by doing experiment that the Fed is making. And it would have to do that no matter who was in the chair's position right now.
Okay. That's played. Do you think that, I'm asking you this because I suspect, but I don't know. That's played a huge part in keeping inflation under wraps, right? Because if, like you said, if those reserves weren't there, receiving interest, they would be what? Leveraged up and loaned out?
I don't know. They'd probably just be those deposits on the Fed's balance sheet allow the Fed to hold mortgage-backed securities and treasury bonds. So you would think that if those deposits weren't with the Fed, they themselves would just be invested in those same mortgage backs and bonds. So the Fed is holding the bonds with those deposits as opposed to those depositors just holding those bonds directly.
But could they
So
not hold them leveraged?
I don't believe it's the case that people say that paying interest on reserves is like paying banks not to lend money.
Isn't it?
I don't think so.
Okay. All right. So you've had time to think about your 2020. Give me something. Not necessarily what the return will be at the stock markets, but anything
Well, I think
juicy and interesting that you want to predict about 2020.
Three risks we should look for. And if these risks don't eventuate, and in fact if they get solved and take them off your threat board, then we'll have another great year. The risk is that the trade war lingers long enough so that it truly impairs China's economy and throws it into recession, which would in turn spill over into a global recession. That is a risk. It's not a forecast. China's economy right now is certainly slowing. It is slowing on a, I don't want to say it's slowing faster, but I think you know what I mean by that. It's decelerating more radically than it would be if the trade war weren't there, although it's probably doomed to decelerate to some extent anyway, just because it's a maturing economy.
But even without that, are we not going into a period of synchronous slowdown?
I just don't know what words like that mean.
Okay.
I just know that they're just these different economies, and they just have different growth rates, and sometimes you would think that when everybody's growing simultaneously, that creates all kinds of self-sustaining trading opportunities with each other, and you can just call that a simultaneous expansion and the opposite of simultaneous slowdown, I guess. But I would rather not think that ideas like expansions and slowdowns are entities or creatures that are just out there and we just have to predict when they'll arrive. Or I want to look at reasons. I want to look at causes.
Yeah.
Right?
Yeah.
Because it's the natural tendency of human beings to get up every morning and work and try to make their lot better and try to be inventive and creative and more productive if you possibly can, for your own sake and for your families. So the bias is for growth. The bias is for progress everywhere in the world, unless something messes it up.
Okay.
So I'm just trying to make a list of things that mess it up.
Okay. All right.
So one would be a China recession. A phase one deal, or at least even the hope of a phase one deal, which is so much better than we were 6 months ago, where the negotiators weren't even returning each other's calls. I mean, it's just nothing but recriminations. At least they're talking now. It's progress. So that's slowed down China's dash in the fog toward a cliff beyond which is recession. Now they're only walking in the fog toward the cliff. And the nice thing about walking instead of running is if you're just walking, maybe you kind of feel the cliff with your toes and you'll look down and at the last minute you'll stop. So the amount of risk in the world has really gone down with the hopes of a phase one deal. We get a phase one deal, it'll go down even more. Now you'll be crawling toward the cliff. Then you start working toward a phase two deal, phase three deal. Takes a big risk off the table. Not the risk of tariffs, not the risk of trade wars and all that jazz, the risk of a recession in China that takes the whole world down. Risk number two. The Fed finally, after 3 rate cuts, has finally cured the inversion of the yield curve. But the yield curve is not steep. It's not a growthy yield curve.
Right.
It's just not going to kill you anymore.
It's just barely not parallel.
Yeah.
Right.
Yeah. It's not going to sustain
with everyone else. Yeah.
Yeah. So at best, the Fed is neutral. I think there should be more steepness to the yield curve.
Okay.
And even in Europe, where you have a lot of negative yields, the shape of their curves is actually reasonably steep. It's just all underwater.
If you accept
but
that
it's steep, right? Yeah. So the old the typical logic of the yield curve still applies, even though it has a minus sign in front of it. We are going to have to see if Powell can do better than his current posture, which is to say the economy is in a good place and policy is in a good place. Oh, you think this is such a good place? So what's GDP going to be in this quarter? What are the sort of the...
By do better, you mean steepen it through forward guidance and actual policy?
Yeah.
Okay.
Yeah.
And if he doesn't, that's a big risk.
If he doesn't, then what this Fed chairman is telling you is that 2% is just fine with him. And that's normal. You're doomed to that. And if we ever get 3%, we're going to all flip out about inflation that we're afraid of but never seems to materialize. So that's the other risk. The risk that this guy will just lapse back into hawkishness. Then the third risk is one that might actually play out this very week. We're in a global oil glut, and it is getting worse and worse. We have been in a secular bear market for oil since 2008. There was a secondary peak in 2014, and oil got as low as $25 in 2016. The reason for it is all good. It's because we have a miracle in the United States called fracking that is making oil limitless in the amounts that can be produced if we want it.
Right.
The problem is we've got these legacy producers in OPEC who they don't have a monopoly like they used to, but they're still a strong cartel. You're not going to get anybody in Texas to cut back production to support prices. The only way you get a Texan to cut back is you cut the price to zero and make it so we can't borrow in the junk bond market. But OPEC meets twice a year and sets what amounts to monetary policy for oil. They're like the central bank of oil.
Right.
They're meeting this Thursday in Vienna.
Okay.
There are rumors flying around about whether they're going to cut production or whether they're not. They have just got to cut production. And if they don't, the oil price is going to be $20 lower a month from now. We've got 2 million barrels a day in new pipeline capacity coming on in the Permian Shale play over the next 5 quarters. When that pipeline capacity gets used by new wells, that is going to bring enough new oil on the world market to be double the most optimistic forecast for demand growth.
Yeah.
Wait, I have an idea. I know what we can do to keep oil prices from crashing. Let's impose sanctions on Venezuela so they can't export anymore. Well, here's an even better idea. Let's impose sanctions on Iran so they can't export anymore. Oh, wait, we already did those things. So who's the next victim? Who are we going to take out? Iraq? Libya? Well, since Trump was elected, U.S. production growth has been 4 million barrels a day, 4.08 million barrels a day. You know what world demand growth has been? 3.86. So the U.S. has captured more than all the demand growth in the last 3 years. It's all come at the expense of Venezuela, Iran, and a little bit from Saudi Arabia. So what's going to happen next year when U.S. production is up another million and world demand growth is up maybe 500,000? Somebody's going to have to give up their market share. And the big question this week is Saudi Arabia is trying to get this Saudi Aramco IPO out. You should look at that prospectus. It's very interesting.
Okay.
The Section 2 on all the different risks, all the uncertainties that they face that they don't insure against. One of them is fracking,
Right.
which is their way of saying market share,
Yeah.
which we're losing, right? So this is
But isn't the other one you don't even really know what they have?
Yeah. Yeah, well, that's
those are two biggies.
yeah,
supply and demand.
Right, but other than that, they've got this thing wired. Well, that's why it's really not the IPO they were dreaming that it could
It's
possibly
not,
be.
yeah.
But
But how is this bad? So all of this seems good. Low prices. We have flexible demand that we can turn on and off, like almost like a light switch compared to the rest of the world.
Here's the
it's
problem.
good, right?
No. Inflation expectations are perfectly correlated to oil prices. Now, we know that other things go into inflation calculations, but if you just look at a chart of the price of oil and overlay it with a chart of the 10-year tip spread, they're the same chart.
Okay.
So if the oil price falls, say, another $20, and tip spreads contract by 25 or 30 basis points,
Yeah.
well, we got to have another Fed rate cut, or that means that real yields have gone up. That means that there's been an automatic tightening because inflation's gone down. You think Powell's going to figure that one out all by himself? I don't think so. So that's one problem. Another problem is, you mentioned earlier the exposure that the American economy has to the high-yield bond market. 17% of the U.S. high-yield bond market is issued by frackers.
Oh, I see.
And
Okay,
when the
so
oil
that'll
price
go into-
collapsed in 2015 and 2016, you know what the spreads to treasuries got to be in that market? 20%. That shut down the junk bond market for the whole first quarter of 2016.
So that train wreck could still be coming. I mean, we
Yes.
waited and waited and waited, and
Yeah.
somehow everyone got out of that.
Yeah.
Like Houdini got out of that,
Yeah.
and we didn't think they could.
Yep.
But now that's coming around again, maybe.
Well, at this time of year in 2014, when OPEC was first waking up to the threat of fracking, they not only did not put any new production quotas in place, they made it the avowed policy of OPEC to produce as much as you possibly can, to teach the world who's the low-cost producer. It ain't you, Texas.
I see.
So that came this close to causing a U.S. recession, but didn't put the frackers out of business. It ended up probably hurting the Arab world more than it hurt the United States. That's what it's always an unstable place. Doesn't help when you don't have the oil revenues to keep your welfare state going.
Got it. Okay. Anything else?
No, those are 3 things to worry
Three
about.
things. All right.
Now,
That's all
look,
I got,
I guess 3.5 is, may we just pause for a moment of silence to reflect on what it would be like to wake up every morning and have Elizabeth Warren be president.
Yeah.
She has a plan.
The sirens are going right now.
Yes, exactly right. Yes, the social media police have heard me say that, and she's dispatching the SWAT team to take me right out of Studio B here. But that ain't going to happen. Elizabeth Warren is self-equilibrating. You know, the great thing about her is instead of speaking in vague generalities, she actually writes down all the math for all her policies.
Yeah.
So you can fact check them, and it's laughable. So it's hard to know what kind of person it would take to beat Trump. You would think a centrist like a Biden or a Bloomberg might be the ideal candidate. I mean, how many geriatric white men are we going to have? Are we going to run in this race, man? I mean, can you imagine the debate between either Trump and Biden or Trump and Bloomberg?
I think Bloomberg is interesting.
Well, you're the first person who's ever said that.
I mean,
I've heard lots of other adjectives. Interesting, never before.
Not as a person, but the idea of inserting him into the race is interesting. The fact that Democrats would have a glimpse of what extreme looks like in their party and say, okay, no, we want this instead, I think is...
Well, the risk with a Bloomberg or a Biden is that they are only covert radicals. Warren's just right out there. She wears her radicalism on her sleeve, and you can take it or leave it. She's like Bernie Sanders, so they're unelectable. Problem with people like Biden and Bloomberg is, you know, they're not into Medicaid for all and forgiving college debt and all this jazz.
So he's going to come after more than sugary drinks if he...
Well, the first thing he's going to do is going to repeal the corporate tax cuts. He's going to move the corporate tax rate from 22% to 35%. Taxes are the largest single expense function in the S&P 500. And if you take that from 22 to 35, you've taken the largest expense function in the S&P 500 and upped it by 60%.
There go your earnings.
Really bad idea. And that is what a centrist is proposing.
Right. Don, I hope you'll come back for a Don Luskin James Grant debate one day. I think it would be lovely to see that.
I might even wear a bow tie for that.
I would love to be there for that. See you guys square off. But thanks for coming in again.
Thank
you. Really
you.
appreciate
What
it.
a great honor. Thank you.
The honor is ours, and hopefully we can do this again sooner than next December, but at the very least once a year, because I really enjoy your take and your outlook, and as we say, the predictions are very valuable, so thanks very much.
Thank you.